On the morning of October 29th, 1929, a man walked into the New York Stock Exchange with $100,000 in his pocket, the equivalent of nearly $2 million today. By noon, he had lost every single cent. What happened on that day? In just 6 hours, wiped out more wealth than the entire cost of World War I. It destroyed banks, ended careers, and broke families across an entire nation. And the terrifying truth? Every single sign was there for years, and nobody stopped it. This is the story of the greatest financial collapse in human history. Stay with me, because what happened in 1929 is more relevant to your life today than you think. To understand the crash, you first need to understand how intoxicating the years before it truly were. The 1920s in America were unlike anything the world had ever seen. World War I was over. New technologies were arriving at a pace that felt supernatural: the radio, the automobile, electricity in homes. And at the center of all this prosperity, burning brighter than anything else, was the New York Stock Exchange. Between 1920 and 1929, the Dow Jones rose by over 500%. $1,000 invested in 1920 became 6,000 by 1929. And here is the part that is truly staggering. You didn't even need money to invest. Brokerage firms had invented buying on margin. You could purchase $10 of stock by putting down just $1. The broker lent you the rest. The shoeshine boy on the corner was giving stock tips. Factory workers were pouring money they did not have into companies they had never heard of. Irving Fisher, one of the most respected economists of his time, a professor at Yale, stood up in October 1929 and declared, "Stock prices have reached what looks like a permanently high plateau." 9 days later, the world ended. But the cracks had been forming for years, and four warning signs were screaming at anyone willing to listen. First, the margin debt bubble. By 1929, Americans had borrowed $8.5 billion to invest in stocks, money that did not exist, backed by nothing but the assumption that prices would keep rising. The dangerous reality of margin buying is brutal. When prices fall, brokers issue margin calls, demands for immediate cash. If you cannot pay, they sell your shares. If everyone gets margin calls at the same time, everyone sells at the same time. And when everyone sells at the same time, prices do not fall gradually. They collapse. Second, the real economy was already slowing. Farm prices were collapsing, industrial production was declining, consumer spending was weakening. The stock market had completely detached from reality. Third, the Federal Reserve raised interest rates in 1928, trying to cool the speculation, but they had waited too long. The system was too leveraged, too fragile. Raising rates did not slow the speculation, it just made the eventual implosion more violent. Fourth, by 1929, the top 1% of Americans controlled over 44% of the nation's wealth. The entire expansion of the 20s was built on a mountain of debt. It was a perfect machine for generating catastrophe. October 24th, 1929, a Thursday. Within the first hour of trading, sell orders came flooding in. Stocks fell. Margin calls went out. More people sold. Prices fell further. Panic spread through the trading floor like fire through dry grass. Outside on Wall Street, a crowd of thousands had gathered in silence. A police officer on duty described it as the most frightening thing he had ever witnessed. Not violence, not chaos, silence. A crowd of thousands, standing in silence, watching their futures disappear. The most powerful bankers in America, J.P. Morgan, Chase, National City Bank, pulled $240 million and began buying aggressively, trying to signal confidence. It worked briefly. By the end of Thursday, losses had partially reversed. A banker stepped out and told the crowd, "There has been a little distress selling on the stock exchange." The newspapers that evening were almost reassuring. The worst, they said, is over. They were catastrophically wrong. October 29th, 1929, Black Tuesday. Over the weekend, brokerages had sent margin calls to hundreds of thousands of investors who had no cash to pay. they were all going to sell, all of them, all at once. First thing Tuesday morning, the opening bell rang at 10 a.m. What happened next was not a market downturn, it was a stampede. In the first 30 minutes, more shares changed hands than typically traded in an entire week. Sell orders came so fast that ticker tape machines fell over 2 hours behind, meaning investors across the country were watching prices from hours ago, not knowing the real numbers had already collapsed even further. The bankers who had intervened on Thursday, they did not come back. JP Morgan's group sat on their hands. They had decided privately that Tuesday's avalanche could not be stopped. They were right. By the closing bell, the market had fallen nearly 13% in a single day. 16 million shares traded. Fortunes built over decades were gone in hours. And this was only the beginning. Black Tuesday was not the bottom. The market continued falling for nearly 3 more years. By July 1932, the Dow had fallen 89% from its peak. A portfolio worth $100,000 in 1929 was worth $11,000 3 years later. It would take 25 years, until 1954, for the market to fully recover. The crash did not by itself cause the Great Depression, but it was the trigger that ignited everything that followed. Over 9,000 American banks failed between 1930 and 1933. Savings that were not insured disappeared overnight. Businesses lost credit, cut workers, workers stopped buying. A catastrophic spiral that fed itself. By 1933, 1 in 4 Americans was unemployed. The richest country in the world was reduced to breadlines and shanty towns. The investigations that followed revealed bankers who had sold worthless securities to their own clients while secretly betting against those same securities. The public fury drove the most significant financial regulation in American history: the Glass-Steagall Act, the Securities Act, and the creation of the SEC. Roosevelt told a shattered nation, "The only thing we have to fear is fear itself." And slowly, painfully slowly, America began to rebuild. Nearly 100 years later, the parallels to our own time are uncomfortable. Markets disconnected from fundamentals, asset prices driven by borrowed money, retail investors pouring into speculative positions they barely understand, experts declaring a new era where the old rules no longer apply. In 1929, the new era was the automobile and the radio. Every generation has its version of the same story. The real lesson of 1929 is not that markets always crash. It is not that investing is dangerous. The real lesson is this: when an entire society decides that risk has disappeared, that is precisely when risk is at its greatest. The men who lost everything on Black Tuesday were not stupid. They were ordinary human beings who confused a decade of good luck with a permanent new reality, and the market, indifferent, merciless, and precise, corrected that misunderstanding in a single morning. Markets are not machines, they are mirrors. They reflect the full spectrum of human nature: our ambition, our greed, our blindness, and our extraordinary capacity for self deception. 1929 did not happen because Americans were uniquely foolish. It happened because they were human. And that is why the possibility of another Black Tuesday is never, ever zero. Those who survived 1929 financially, who held cash, who had no margin debt, who bought at the bottom when everyone else was selling, built some of the greatest fortunes in American history. They taught their children three things: never borrow to invest in what you don't understand, never confuse a rising market with your own genius, and always keep enough in reserve to survive the day when the crowd runs. That lesson was paid for at an unimaginable price. It would be a tragedy to forget it. If this story made you think differently about markets and risk, hit the like button and share it with someone who needs to hear it. Our next video covers the man who actually predicted the 1929 crash, walked away with his fortune completely intact, and built a system that still influences how the smartest investors in the world think today. Subscribe, turn on notifications, and we will see you next time.